Well, hello and welcome to this short talk that was first given at the OpenNMS Users Conference in 2014 at the University of Southampton, but which I have now re-recorded so that you can download and stream it. My name is Craig Gallen and I'm the Director of NOCs Limited, which is the OpenNMS partner in the United Kingdom, and I've been working with OpenNMS for around 10 years. So in this talk, I'm going to try and introduce some ideas of where the future might be going in terms of optimizing cloud and network asset utilization. And I'm going to be looking at some lessons from the finance industry to help us understand what the future NOC might look like. And then I'm going to talk about a little implementation called the OpenNMS Pmatrix Display, which is beginning to look at the ideas that I'm presenting in this talk. I should, before I go any further, give thanks to TMX Atrium, who sponsored the development work that's been demonstrated as part of this talk. TMX Atrium are a network provider that specializes in providing networks for high frequency traders, and so some of the lessons from the finance industry are perhaps particularly appropriate to them. So when we think about OpenNMS and how it can be used in the business, it's quite useful to take a business process framework like the TM Forum ETOM and look at the particular activities which OpenNMS can address. So this particular diagram shows the various operations and processes that happen in a service provider, and then begins to highlight some of the things which OpenNMS can do. So OpenNMS primarily is used around resource data collection and distribution. It collects performance data and fault data, and therefore finds a lot of its use in resource trouble management or resource performance management. Now, in this talk, I'm particularly interested in looking at resource performance management, service quality management, and then customer QoS and SLA management, which OpenNMS can be used for, but which historically it hasn't been used for a lot, and I'll talk about that in a minute. Again, in terms of capturing performance shortfalls and planning the future of the network, both for services and for resources, OpenNMS can be used for that, but perhaps isn't used to its greatest advantage at the moment. So let's talk about OpenNMS performance management as it's presently done. So we have a very solid foundation in terms of polling for data collection. We can collect from multiple sources. Obviously SNMP is the primary source, but we can pick up from JMX and many other ways. We collect on a regular basis, and OpenNMS, being open source, is low cost and very highly scalable. So a solution for data collection based on OpenNMS can be scaled to a very large size, the only cost being the cost of the hardware that's used to store the RRDs. We do reasonably good visualization of the data, but we're reusing in a lot of cases the RRD libraries themselves from the RRD tool project, which we heavily utilize in OpenNMS at the moment. But the problem with our visualization is, as you can see here, it gives you statistics on a per node basis, but it doesn't necessarily give you the ability to see statistics from multiple nodes at the same time. I know there are ways of displaying multiple nodes at the same time, but there's no easy way to correlate data between multiple nodes. So you can find out that there's a problem, and you can go and look at the historical data, but you can't necessarily use that historical data across nodes. We have threshold alerting, which it's very binary. We are able to cross a threshold, come back over a threshold. There's a certain amount of hysteresis around that where we can set high, low thresholds. But one of the issues here, of course, is that over time thresholds change. and performance can go up and down regularly in your network according to a pattern which you're aware of and which you're happy. OpenNMS can't necessarily track that, and so finding things that are unusual are not something that threshold alerting necessarily does. Now, we've introduced Jasper reports, and Jasper reports can pick up RRD data sources, so we can combine data sources into a report. But again, it's not a wonderfully beautiful solution. Jasper reports really is more suited to picking up information from the database, and picking up data from RRDs is not that easy to write or do. So the question is, what can we do going forwards? I should mention we have the near real-time graphing, which is wonderful if you want to monitor something for a maintenance purpose. And in the future, we are moving from RRD to Cassandra, which opens up a whole raft of possibilities in terms of how data will be stored and how it can be accessed. Eric Evans will be giving a talk on this at the conference, and I won't talk any more about it now. But some of the ideas that I'm presenting are very well suited to what we can do with performance going forwards. But one has to say, and this really is the bottom line, that we collect a lot of performance data, but it really doesn't drive the average NOC. When I speak to people, network operations centers, yes, it's nice to have the performance data there, but generally speaking, they only look at it when they think they've got a problem, and not that often. So a lot of data is collected, but we probably don't use it to its maximum advantage. And that really is the current state of performance management within OpenNMS. But I would venture to say also within any other performance management platform that you might mention. Now, when we look at what's going on in the network or in the marketplace, we can see that there's a huge amount of hype around virtualization, and I'll just read out this for you. Our servers are using too much electricity, we need to virtualize, says the pointy head boss. I did my part by reading about virtualization in a trade journal, now you're to do the software part. Why is your part taking so long? There's no need to worry about the server virtualization project. In phase 1, a team of blind monkeys will unplug unnecessary servers. In phase 2, the monkeys will hurl software at whatever is left. Voila. So, there we go. It's just a funny cartoon, but there probably is a lot of hype around virtualization and what it can do for you. Now, having said that, there are some real significant drivers within the marketplace, and one of them is power consumption. So if you've got a small network and a small number of servers, you probably aren't that concerned about power consumption. But if you've got something like Google would have, or the NRA or whoever, then you've got a huge problem, because the power consumption of your data center is a significant cost. And as Greenpeace have pointed out in their latest report, globally we're using 623 billion kilowatt hours to drive our data centers, and that is horrendous, really. And the question is, what can we do about this? And obviously virtualization is a way in which we're trying to maximize the utilization of hardware, minimize the use of resources. Power consumption of a data center, if it could be reduced by even a few percent, could actually save an awful lot of money for a number of large data center providers. Now, when we look at virtualization, the question is, well, why are we doing it? And it seems in one sense a no-brainer, but in another sense it's quite often the case that people don't actually know how to demonstrate their return on investment in terms of how much they've spent for their virtualization, and the difficulty of making the migration, and then the ultimate results of that. And when we look at this, there's been a report of government officials in the United States, and they've said that they've been trying to get better utilization, lower hardware costs, and reduce physical footprint, which are fine, and you can measure those to a certain extent. But in reality, how are we able to measure, when we virtualize, the effect that it is having on our customers, whether we're actually doing better or worse than we were when we were not virtualized, and which systems should we virtualize and which systems should we not virtualize, and which systems should be combined on the same virtual platform and won't interfere with each other. These are big questions, and at the moment I would suggest that mostly they're being addressed by finger in the air engineering practices rather than a clear collection of data and using that data to drive investment decisions or to show return on investment. Now, one of the things that when I used to work a little bit with cable and wireless, one of the guys there used to say, we need to sweat the assets. And by that they meant they had a huge number of DMS switches and they wanted them to run at the highest capacity possible so that they were getting their maximum return on investment. So they wanted to maximize their call throughput at any point in time in order to make sure that their assets were being used most efficiently. And that really is the case now with data centers as well. I think, since we've been following Moore's law, the cost of bandwidth and the cost of storage has been going down steadily. But the reality is it's not keeping up with demand, and where perhaps in the past it was important for voice traffic for people to be thinking about capacity management, people haven't really been that concerned about capacity management. But now that demand is going through the roof, it isn't actually possible to keep up with demand in a cost-effective way, and it's becoming much more important to think about how the assets are being used and whether they're being priced properly to the end customer. So we have finite assets in terms of power consumption, bandwidth, CPU, memory, storage, and for the largest data centers in the world, a few percentage improvement in the utilization of those assets could be very significant cost reductions. And this obviously applies even more so when we move into the cloud, where we actually are providing brokered cloud services across many users. How are we maximizing the utilization of our cloud infrastructure and making sure that our users are getting the right quality of service relative to what they're paying for it, at the same time relating that back to the actual consumption of the finite assets that we have in our data center. It's a very big problem. Now, OpenNMS currently measures everything that's relevant to virtualized services. We can measure the end user experience through our remote pollers and various other technologies. We can see how fast pages are loading. We can see the experience from a remote location of a particular service. OpenNMS also has capabilities which we've introduced around managing cloud services, VMware being a good example of what we've started to do in this area, where we can see both the VMware hardware and the virtual machines that are running on it and give an idea of the relationship between the two. And obviously we're able to look at the physical infrastructure. So we have the ability to gather all of this data, and I would suggest going forwards this will be much more important, where we're in a situation where perhaps we're not able to see the underlying hardware or virtualized infrastructure, but because our users of OpenNMS are accessing services in the cloud, all they can actually see is the experience from their perspective of their services running in the cloud. And in that case, it actually becomes important for OpenNMS to be able to measure proprietary protocols and also to begin to think about open data and RDF measurements, so being able to measure SPARQL endpoints. And indeed, when we get to the Internet of Things, we're going to see an explosion in this area where cloud services are supporting thousands of things out there. And again, it represents an opportunity for OpenNMS to be looking at those virtualized services. So at this point, OpenNMS is actually quite well positioned in terms of being able to see the entire infrastructure plane. But what can we do with the data that we're collecting, and how can we more usefully present that data in a way that can help end users? Now, one of the other problems that we are seeing is the moving to virtualized networks. So we've seen in a previous diagram that we're able to sort of measure a classical data center, but going forwards, it's very clear that we're not going to have discrete routers or discrete network equipment anymore. That itself is also going to be running on commodity hardware as functions within a cloud environment. And we're seeing, with OpenFlow and with network functions virtualization, that the overall infrastructure is going to be a mixture of compute and also a replacement of hardware with stuff running on standard volume servers. And so we'll be looking at the network as just another compute function within the cloud environment. So again, OpenNMS is well positioned to address this problem space, but the problem space is coming across us very, very quickly. Now, in order to think about the problem, we need to think in terms of what a service level agreement is in that sort of problem space. So this is a diagram taken from the TM Forum Service Level Management Handbook, which really just tries to structure the problem of how do we understand a service level agreement and how it's calculated. And really, when you step back at it, basically a service level agreement is very like an insurance or an option. So obviously in an insurance contract, the taker of the contract, the insurance provider, will guarantee to pay out a certain amount of money if you die before a certain age. And they obviously look at people's health, and they look at the probability of somebody dying at a particular age, and then they price the insurance contract accordingly. And similarly with SLAs, we would expect that a service provider, when they offer an SLA, are looking at the probability of them missing that SLA and what it would cost them to miss it, and then are able to factor in financially what the dangers are to their business or value at risk to their business if for whatever reason they're not able to meet that SLA. Now, obviously, if you're going to do this, you would probably want to be quite sure that your network or infrastructure is actually most of the time able to meet the SLA, so that you're not going to be fleeced by your customer whenever your network isn't proving to offer the SLA that you have priced for. And the question then comes down to, well, how do we actually know the value at risk? Now, this diagram is really saying that an SLA is structured usually in terms of service impairment factors, which are basically whatever things we determine within a particular infrastructure are important to measure. Then we determine, okay, well, having understood what those impairment factors are, what are the key performance indicators that we need to measure in order to be able to see what's going wrong in the hardware. Key performance indicators are really from an engineer's perspective what's going wrong. But the key quality indicators are from a customer's perspective what's going wrong. My web page won't load, my video is jittery, my voice sounds strange. So key quality indicators are clearly related to key performance indicators, which are then related to measurements against a particular infrastructure. And an SLA will be structured around these various key quality indicators and key performance indicators. But again, the question is, I take an agreement to supply this, how do I guarantee that I'll do it? And I would suggest at the moment that the reality is, if you've got an important customer, you over-provision, and you hope to goodness that you've over-provisioned enough to meet that customer's need. And for customers that aren't very important, you just cross your fingers and hope it'll be alright. But clearly that's not a very effective way of managing your SLAs, and if the insurance business ran that way, they'd probably be out of business fairly quickly. So there is a need to move forwards with how we manage service level agreement calculation, and also move forwards with how we understand our underlying network. Now, in thinking about this, I have been looking at what goes on in financial brokerage markets. Now, it's very interesting. Obviously, financial markets deal with time series data, which is very similar to the data that OpenNMS collects. But the time series data in their case is the price of stocks and shares. So they are constantly monitoring the ups and downs of various commodities in the market, and they have used the ability to create a large-scale market in tradable assets in order to be able to broker stocks and shares and be able to understand the price of portfolios. So, what makes this possible? Well, in order to broker stocks and shares in a large financial market, the first thing is you have to have standardized contracts. So by that we would be saying that you need to have SLAs in the network sense that are standardized, are measurable, independently measurable, and are clearly well understood by both sides. If you have a contract that is different for every customer, that adds a huge amount of complexity to the problem. Now, interestingly, there's been some work going on with the Chicago Stock Exchange, actually looking at how do we build a market for cloud services, and how do we price such a market. And there's been some patents in that area. So these ideas that I'm putting forward here are not completely out of the way. There's other people thinking about it. So anyway, we need standardized contracts, we need common independently measurable indicators, and we need market fluidity. Now, this has obviously been a problem before the introduction of cloud services, but now with things like Puppet, with the various OpenStack large-scale cloud platforms, it's possible to move your services around, not just within a particular data center, but between data centers and between data center providers. So market fluidity is now not much of a problem. So if you can measure what's going on, you can make choices based on where should I run my particular service in order to maximize the benefit to my customer. And this works both ways. It works for the data center provider who can maximize the use of their assets, but it also works for somebody who's buying cloud services, because if they can measure what's going on in each of the service providers, they can get a good idea of where the best place is at any point in time to run their service, and they can move their services quickly from one provider to another. Now, in the financial markets, investors invest based on the expected future price of an asset, and the volatility of an asset represents the risk of return on that initial price. So in this diagram we can see that if you invest in government bonds, those are basically the safest things to invest in. The government always pays, but the interest rates are pretty terrible, down at 1 or 2% at this point in time. Have been higher in the past, but really you get a minimal return on your investment if you buy government bonds. Now, if you buy blue chip shares, well, they're relatively low risk. Shares in IBM or Microsoft or whoever, will go up and down, but they won't go up and down that much because they're big companies that are, as they say here, blue chip. Things like Rank Hovis McDougall, who sell corn and bread and the like. It's something that people always need. Their business won't go away. Their shares are pretty blue chip, but to be honest, they're not wildly exciting, because they go up and down, but they don't go up that much. They just give you a relatively good return on your investment. But other shares, in IPOs, initial public offerings, or venture capitalists, or new companies, new entrants into the market, might be high risk. You might not get any money back at all. But on the other hand, if you did get money back from those shares, you get a lot of money back, because you've invested in something that's new and potentially could represent a real killing for you. Now, what in fact people do is that they will take a portfolio of shares and they will mix the sort of low risk shares with the high risk shares and build a portfolio that balances those risks. The idea being that you will get some expected return from a portfolio, but you might get a really good return if your high risk shares actually took off. But on the other hand, because you've balanced them up with low risk shares, then it's possible that when they go wrong, at least you're getting some money back from the others. Now, what people actually also do is they try and balance those portfolios in terms of the variance of the shares. So, for instance, you can have high risk technology stocks, and you can have low risk food manufacturing stocks, for instance. Now what happens is that when the economy tanks, then the high value technology stocks tank because nobody's buying technology, but people are always buying food, so the food manufacturers, the value of their shares goes up relative to the shares of the other companies because they're not related. But in the other times, you know, when you've got the stock bubble for the .com bubble and that sort of thing, then the technology shares are really high, and the boring but reliable food shares are low. So the question is, how do you build a reasonable portfolio of assets, and then how do you price that portfolio of assets to give you a view of your expected return and your value at risk? So that was a very short discussion around financial brokering, but as you might be able to see, the same ideas could be applied to data centers. So one of the things that was very instrumental in the development of the financial markets over the last 30 years or so was the ability to use something called the capital asset pricing model, CAPM. Which is a model for pricing an individual security or a portfolio. And basically, without going into the math, what it does is it allows you to look at the previous values over historical time that a particular stock has taken. You then calculate the variance on the stock, or what they call the beta, and then you're able to put together a portfolio of different stocks with different betas and actually calculate what the price of that portfolio should be. So it's something that wasn't possible to be done before, but which some very clever mathematicians put together the ideas around it, and it allowed people to begin to think in terms of doing credit default swaps and these sorts of things. So as we can see in the diagram, you know, the risk-free rate of return basically is if I'm buying, just loan stock from the government, but then there's higher beta, which is higher rate of return but higher risk in terms of buying a portfolio of emerging companies in China, shall we say. Now the implications of this are that you can calculate the beta for a portfolio of assets using this historical time series data, and you can price a portfolio based on the risk and correlation of the underlying assets within that particular portfolio. And the choice of the portfolio is determined by mixing assets which have limited or covariance or orthogonal covariance. In other words, you want to mix your stocks so that you might have a high risk portfolio, or you might have a low risk portfolio by doing the right sort of mix of the two. Now, as we all know, this all went horribly wrong during the 2008 stock market crash, because the models that they've been using for pricing this stuff basically didn't account for human behavior or account for the fact that people were lying. But that doesn't mean that the math is completely wrong, and particularly in the case of analysing data centres, we're not really talking about human behaviour to the same extent. We're talking about something that's much more deterministic, although there is a certain stochastic element to it. And although data centre behaviour is influenced by human behaviour, because particular sites may get lots of hits at a particular time because of human factors, nonetheless the measurements themselves are accurate, and it's possible to do this sort of calculation with a reasonable degree of accuracy, as opposed to perhaps what you might be doing when you're applying this sort of math to the stock market, where past performance is not guaranteed, is not a guarantee of future returns. So, is it possible to apply these sorts of ideas to the data which OpenNMS is collecting in a data center? Well, having a look around, I came across something called OpenGamma, which is an open source trader desk platform, and I really wanted to just look at this as something to think about in terms of, this is good. Does this show us some of the things that we should be thinking about to try and solve these problems? Now, I actually have a running version of OpenGamma here. As you can see, OpenGamma platform, unified system for front office risk calculations for financial service firms. It actually is a Java application. It runs using time series data, and it monitors stock prices on an ongoing basis. And here's a simulation of it running. As you can see, it's got various stocks going up and down, and it's got ability to have portfolios put together. I won't go into the details of how this thing works, but basically to show you that this is, as I say, a Java platform, runs on Tomcat, and is used by traders in a lot of environments to actually be able to look at the value at risk for their various portfolios that they have. And my question is this something that we should look at as a model for looking at data centers in a similar sort of way? Is there something we can learn from this? And indeed, given it's an open source platform, it may even be that we could reuse some parts of it to do what we need to do. So, what am I really saying? Well, what I'm saying is that I think we should be thinking about how do we make the Network Operations Center more like a trading room. There are basically two approaches to trading. One approach to trading looks at business fundamentals. The other approach to trading looks at quantitative methods. So business fundamentals is basically what you do when you look at a firm, you look at their strategy, you talk to their various managers and directors, you take a look at their past performance, and you think about what are they going to do going forwards, what's the market doing, and that. You're taking a judgment based on the fundamentals of the business through a detailed understanding of how you think the business is running. Quantitative methods, on the other hand, are basically the methods that I talked about previously, where you don't care how the business runs. All you care is the stock price. You look at the stock price going up and down historically, and you trade based on some complex mathematical calculation that takes no account whatsoever of how the business is actually structured and what the managing director says he's going to do next. All you're interested in is what the actual stock is doing in the numbers historically. Now, I would suggest to say that basically what we do in network operations centers, when and if we look at performance at all, is this business fundamentals approach. We're basically saying we understand our network, we know how it links together, we kind of know what happens when things go wrong, and when we're presented with a problem, we know where to look to find the problem. Well, that's very good, and that won't go away, and it's an important way of managing the network, and I'm not discounting that, but OpenNMS is entirely suited to this type of approach. However, it may be that we should also be looking at these quantitative methods, where we're actually saying, you know what, in a cloud environment, we do not actually know the underlying infrastructure. We just know some data about how some of our services are running within that infrastructure over time. And therefore, all we can do is look at the historical performance of the whole infrastructure and try and move things around based on what we understand about the measurements we can measure, but with limited understanding of what's going on in the actual underlying network. Excuse me. It's interesting, I mentioned it at the beginning, but remember traffic management for voice services? This is something that was very important way back when people looked at how to do least cost routing for moving voice services around. It became less of an issue when bandwidth became cheap, but now I think we're moving back to a situation where we actually should be doing active traffic management, active portfolio management of what virtual machines are running where, and active management of the SLAs based on the underlying calculations. So what does this look like? Well, from a fulfillment perspective, we're able to produce a strike price for service level agreements based on real network risk data. So we're not just putting a finger in the air, but we're saying if I take this order and I fulfill it in this particular way in this particular data center, then I know that this is the risk that I am taking with this particular customer. Gives us the ability to increase our utilization by actively managing the risk. In other words, we're putting together portfolios of services and machines in our virtual infrastructure that play together nicely, and moving out to other infrastructure, those services that are much more random in their requirements. And then we provision our machines and bandwidth based on expected correlation between co-hosted services. And that obviously is something we probably don't do at the moment, but which would be very useful if we were able to get to. From a assurance perspective, we're able to look at real-time visualization of the asset performance within the data center, so we can look and see what's going on at this point in time. Should I move things around? Is there something that doesn't look quite right? Interestingly, the increased variance, so if we're actually experiencing instability in our data center, that can point to the fact that we're near an edge at some level. And as you know, with TCP/IP, for instance, if you're way up in capacity, you can have the sucking sort of situation where things go fast and then they go slow and then they go fast and then they go slow, and it's an effect of the TCP/IP protocol backing people off whenever there's too much capacity demand. Same thing happens on the M25 motorway. People are going too fast. Then you get this travelling wave of suddenly all the cars stop and nobody knows why, and then they start going again. And they use traffic calming measures to reduce that effect. Well, the same sort of thing I'm talking about in a data center, that if you can pick that up, then you can begin to apply controls that would stop that happening in your environment. So what then does all this mean? Well, I think first thing is that there is definitely going to be an emerging market in brokeraging compute, storage and bandwidth, and brokeraging SLAs between service providers. We are already seeing this happening, and we're seeing that various efforts are being put in place to try and standardize the contracts so that it's possible to move services around between providers. In order to come up with an SLA and to create a strike price, you need to key quality indicators over a time window, and you need to understand the rewards and penalties associated with what it is you're selling. In terms of trading options, you trade over a time window, and there's a price and there's an upside and a downside risk. And again, you need to be able to relate that back to the reality in your network. Now, an option is the right but not the obligation to buy or sell an underlying asset or instrument at a specified price on or before the specified rate. So again, options really are what we're talking about in terms of selling and buying bandwidth. We're putting together portfolios of bandwidth or compute. We're packaging them up and selling them on to people who need that bandwidth and compute at a particular time for a particular purpose, and we need to be able to understand the performance of the underlying assets in order to do that properly. Now, what these two diagrams here are very simple. It's just giving you a bit of an idea of what I mean by correlated demand and uncorrelated demand. So you can see here, orthogonal demand, in this case, when one service is going up, the other service is going down. So the overall utilization stays at 90% for everything. So this is the ideal situation where you have two virtual machines running on a physical CPU, and the two virtual machines are basically using resources at different times such that overall utilization is flat. Now this never obviously happens, but that's the ideal orthogonal demand situation. In this case, you don't have orthogonal demand. What you have is a situation where these are actually the same values but shifted slightly, and what we see is that sometimes you're underutilizing your assets and sometimes you're maxing out your assets. as you can see here, in which case somebody is suffering. And of course the question is, who is suffering and what does that mean to my environment? But the fundamental question is, how do I choose which services or servers to put together in order to maximize the utilization and avoid the situation where we're maxing out or where we're underutilizing our assets. So that's fundamentally what I'm talking about in terms of trying to put together a way of supporting a marketplace and supporting also the maximizing of optimization of your data center. Now the other thing that's very interesting that you can do if you begin to get this sort of data is, as I said, with a network provider you may have multiple customer premise equipment that are connected from your perspective in your network, but it's all going through a network provider, and you have no idea what the network provider has done. And you may have purchased diversity, in this case CPE, 2 circuits, diverse arrangement, but the reality is they may all be going through the same pipe. You just don't know. You can't be certain that the network provider is actually providing you the network that you thought he was. So, but the question is, if we measured the ingress traffic and egress traffic of a particular network, can we tell what's going on within the network? And it turns out that there's some work that has been done, interestingly looking at biology, but it actually suggests that it is possible to look at the relationship between networks, or even to predict the network provider network based on CPE measurements. So again, OpenNMS is very well suited to measuring the experience of a network provider, and to be able to predict what the network, the underlying network looks like, and also begin to see if the underlying network is having problems. So, I've said a lot, I've put forward loads of ideas, and is this real? Well, we've made a start, and the start is this Pmatrix display that I'm going to describe, which we'd put together with TMX Atrium. Now this is the very beginning of what we're looking at, but again, hopefully it gives you an idea of where we're thinking. So what were the requirements that were put to us? Well, the customer requirement was they were providing circuits between various different locations, and they wanted to have a display that would show the latency between those locations, because as they offer high frequency trader networks, they wanted to be able to show that there actually wasn't a problem between, and also note what the problems might be between these things. They wanted to have it on all-in-one display, a view of what was going on. So the requirement was collect the latency data, show the latest value, and then compare it to the average value over the last month. If there's more than 5% variance, highlight the value in red. And then beyond that, can we integrate this into the OpenNMS performance displays? Can we, easily configure it? And can we have more than one matrix for display to different customers or for different purposes? So that really is what the customer required. And other requirements then we had for that were, we want to be able to use any data collected by OpenNMS collectd. So whenever OpenNMS collects the data, can we pass it on to this display? We want to show the data in real time. We wanted it to be standalone or integrated, so it could run within OpenNMS, or it could run as a standalone web app separately to OpenNMS, but taking data from OpenNMS. We wanted it to support multiple Pmatrix displays, as we said, for different purposes. And we also wanted it to support different calculations. So simple moving average is what we're offering at the moment, but there are other things we can do. For instance, the exponential moving average is a very efficient algorithm which doesn't require you to store stacks of data in memory, but at the same time is used a lot by financial traders. That's something that we could try. And then can we persist the data as well, so that it's periodically backed, because it isn't running actually necessarily as part of OpenNMS, we weren't going to store the data in the database, but we were going to store it off on a regular basis, but actually do all of the calculations in memory in real time. So what we came up with was this is OpenNMS as it exists today, and there is a feature that allows you within OpenNMS, I think from 10 dot something it existed, but certainly in 1.12 it definitely exists. It provides you a protobuf TCP performance data forwarding, so you can basically tell OpenNMS every data that you collect, send a little message out of OpenNMS to a known address, and that's how this works. So this separate Jetty web server contains this application that's listening for these messages from OpenNMS and then is doing something with those messages. So what does it look like? Well, the idea is that you basically have measurements that are displayed, columns and rows. You can choose whatever you want those columns and rows to be. Then you've got a calculator for each row that calculates the, in this case I think it's the overall average, and then the absolute value. It could be maximum value and actual value, various different options. And then these arrows are showing what's going up, what's going down, and gives you an overall display. And then when you put a mouse over the text, you can actually see the underlying data. And if you click on it, it'll actually take you through to the OpenNMS RRD display. So that really is what the overall thing would look like. And if I show you that now, this is actual Pmatrix display. Now in this case it's blue. The reason being blue means that no data is being collected. I'm not sure why that's the case, but you can see here you've got a number of measurements, and again the columns, and then the actual values being collected. When you mouse over it, you can actually see the underlying data. And if I won't click on it because it won't take me to the actual OpenNMS display, but if I did click on it, it would take me to the OpenNMS RRD display. It won't do it in this case because we're behind a firewall. But really just to give you an idea of what the display looks like, and this allows you to see relationships between various things within your data center as a starting point. So how does it work? Well, from an internal perspective, the OpenNMS is sending messages, and that basically is going to a hash table where something called the file path key. Now every message has got a file path associated with it. The file path is the location of the RRD to which that message is being sent. So the file path key is used to relate to the calculator. The calculator is a class which basically stores the data over time and performs the real-time calculations that give you the data to show on the display. And so for every file path there's a related calculator. Over time this is all stored off historically, so all the data in each calculator. So for instance, you could have a calculator that was collecting 1,000 points in a round-robin basis. That would all be stored off historically, perhaps every day or every half hour, depending on what you felt you needed to do. It's not intended to be a replacement for RRD. It's just a fast startup mechanism for when you get going if you did have to restart. So anyway, all the data points are stored, and then you've got multiple table definitions which relate the file path key to the row and the column values. And then, so having multiple tables defined, then the Ajax VADN display can show one table or another table depending on what URL you point to. And as the inputs are coming through, all of this is being updated in real time. If I show you the configuration, again, this is the config file that's used for this. As you can see within the config file, you basically define the calculator. This is the actual class. In this case it's simple moving average implementation, but you could put in any class you wanted there that did the calculation that corresponded to the defined API. Then for the calculator, you've got various configuration items in terms of sample timeout. So after a particular time, if no sample has been received, then the display will go blue. So that's sample timeout. Maximum number of samples is the number of samples which are stored in a round robin for this particular simple moving average. Then you can determine what the lower or upper value in each of those cells are, and then you can determine what the threshold type is for determining what the color of the cell is, and you can also determine then what the value is in terms of the warning, the major, the minor, and the critical thresholds relative to the average or relative to the standard deviation or anything else that's been defined within the calculator. Then within the actual Pmatrix specification that defines the calculator, you have a title, table of very important values in this case. You can determine the width and the height of the table. And there's various other settings we won't go into because they're all written up here and you can see them separately. But row names, column names, these can be anything that you want them to be. And then for each row and column, you then can put in the actual file path, which corresponds to the message, and then the URL, which would go to the OpenNMS RRD file corresponding to that message. Now, in future, we would want to have automatic configuration that allowed us to create this rather than having to do it manually, but that's to be done. You can put initial values in. This is really more for testing rather than for reality, and but it allows you to set up the thing and test. You can also put in additional text as HTML on the page, and you can define more than one table, as you can see here, with preset values if you wish. So that just gives you an idea of how it's configured. So what are the next steps? Well, Pmatrix 1.0, which we've sort of shown you here, will be in the OpenNMS contributed directory. Not there yet, but around about DevJam it should be up in there. 1.1 will be much more integrated with OpenNMS as a feature that can be downloaded and installed, and hopefully we'll have configuration tools as part of the UI, and perhaps use ActiveMQ instead of protobuf for forwarding the messages. But the future really is, where do we go from here? And that really was the purpose of the beginning of my talk. These are the things that we think need to be addressed. This Pmatrix stuff is just a beginning, but where can we go in order to provide real-time trader-like displays of performance data that's collected by OpenNMS? We need sponsors who want to progress this work. We would ideally want somebody with access to real data sets that we could try out some experiments with to see what the data really means. We would love to do a short research exercise. We have some researchers at the University of Southampton who are mathematicians who would love to look at what the data actually means and whether we can get some useful calculations out of it in terms of cross correlation and the like. And we would really like to work with somebody who's genuinely interested in modelling data center efficiency and in brokering services, because we think this is an important way forwards for OpenNMS. So, thank you very much for listening to this recorded presentation. If you have any questions, please email me or contact me through the blog. Very happy to talk with anybody who wants to see this work going forwards. And thank you once again for listening, and thank you also to TMX Atrium for their sponsorship of this work. Thank you.